Welcome, dear learners for Curious Commerce. Today's we are discussed about the topic on history of finance, the part one. Investors. The Industrial Revolution and 19th century, the rise of the investment bank, the need for the massive capital to fund railroads, factories, and industry led to the specialization of financial firm. The Industrial Revolution requires a huge amount of money to build factories, to construct the railway tracks and steel mills. Individual wealthy family or the small banks could not fund these massive projects alone. Powerful bankers like JP Morgan stepped in. They helped the companies issue shares and bonds to the public, gathering the capital needed to build America's industries. These investment banks were the gatekeepers of growth. A portrait of JP Morgan representing the power and influence of the early investment bankers who financed industrial expansion. The gold standard, a system to ensure stability and liquidity across international markets. Many major countries tied their currency directly to a fixed amount of gold. This meant one country's money could always be converted to another's at a predictable rate. It kept prices stable and boosted global commerce. A simple graphic showing how the gold standard linked national currency supply to gold reserves, promoting exchange stability. Without the rules, the system often failed. The panic of 1907 saw investors lose faith, leading to bank runs and economic crisis. JP Morgan himself had to step in as a private individual to bail out the system. The Federal Reserve in 1913, America realized it needed a permanent safety net. The Fed was created to manage the money supply, act as the leader of last resort, the bank for the banks, the stabilized financial system. The historical newspaper clipping to illustrate the public and systematic impact of unchecked financial, a Great Depression and new roots. The stock market crash of 1929 and the resulting Great Depression showed that the system was fundamentally broken. Banks failed and people lost all their savings. That's why the government stepped in with the regulation. The US established FDIC and SEC to regulate the stock market, FDIC to ensure the deposits. The new rule, that rule is maintain the transparency and protection for average person. That's the building of Federal Reserve Building of the exterior. After the World War II, the world needed a stable system for global trade without returning to the risky global standard. Just imagine this. After the World War II, huge depression in almost all the nation's economy, huge distraction in the financial instabilities, no proper trade and commerce, no proper standardized export and import. At that time, in 1944, Bretton Woods Conference established the US dollar as the world's reserve currency, backed by the gold. This created decades of predictable exchange rates and massive global growth. It also led to the creation of IMF, International Monetary Fund, and the World Bank. The photo of the Bretton Woods Conference of 1944, where leaders established the post war global financial order that powered economic growth for decades. The rise of academic finance. Finance emerged as a distinct, rigorous academic discipline separated from the economics, using mathematics to solve real world investment problems. Before the mid 20th century, investment or the investing was often based on guesswork. Markowitz changed that with the modern portfolio theory, that's called as an MPT. You should not just look for the high return. You should focus on minimizing risk for a given level of return. Modern portfolio theory uses maths to show investors the most efficient mix of assets like stock, bonds, or any financial instruments. The Markowitz modern portfolio theory graphics we deeply discussed later related to the modern portfolio theories, how we should select, how we should create the portfolio, and how we should plot it according to the MPT. Modern finance, globalization, and digitalization, financial engineering, and globalization. This is the proper terminology to explain this context. As the market grew, the shares, bonds, or financial instruments market, when the market grew day by day, so did the complexity of risk also increases. Companies needed way to insure themselves against the future changes in things like the interest rates or the commodity prices. Means they want to minimize the risk of the future prices or the interest rates. That's why they introduced the new financial tool, that tool called as in the derivative. These are the financial contracts whose value is derived from an underlying asset, like oil, a stock index, or a loan. Tools like interest rate swaps allowed companies to hedge or neutralize the financial risk. The basic flow chart showing how two parties exchange fixed and floating interest payment in a swap agreement, a key tool in modern corporate finance. A great financial crisis in 2008. While the derivatives were powerful risk management tool, they were also used for the massive speculation. The financial engineering around subprime mortgages created a toxic web of the debt. The event of 2008 global financial crisis revealed that interconnected financial institutions could bring down the entire system, providing that financial innovation requires strict oversight. So, a chart showing the dramatic rise and fall of US home prices leading up to 2008, illustrating the speculative bubble that causes the global crisis. The fintech revolution and cryptocurrencies. Technology is now fundamentally changing how we use money. Financial technology is making banking services faster, cheaper, and more accessible through mobile app and AI. The biggest challenge to traditional finance is cryptocurrency and blockchain. For the first time since the Lydian coin, investors are proposing a form of money, Bitcoin, and record keeping, blockchain, that exists entirely outside of banks or government. This marks a truly new chapter in the history of finance. The graphic combining the icons of mobile banking, blockchain, and AI representing the key trend that define the future of money, fintech coins, and crypto logos. We are at the end of the session. The history of finance shows that money is an invention, not a force of nature. Every tool, from the Mesopotamian tablet to the blockchain, was created to solve a specific problem: how to share the risk, facilitate the trade, and store value. Invention is constant. People will always invent new ways to use money. Risk require rules. Every great invention is eventually followed by a crisis, forcing us to create new laws to protect the system. The takeaway from this session is innovation is constant, risk requires rules. Thank you. If you are interested about this type of the videos about the economics, financial management, or any other commerce domains, share and subscribe to this channel. Thank you.